You're listening to Capital Topics, episode number 81. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In our podcast today, we will review year-end tax planning strategies for investors in capital markets. Enjoy! Good morning, James. How are you today?
I'm very good today, François. And how about you?
I'm very good, thank you. So, it's that time of the year again when we cover year-end tax planning strategies for investors in capital market securities. As our regular listeners know, this is an annual tradition on our podcast to cover this topic at year-end. We had originally planned to publish this podcast in October, but the Liberal government decided to table their 2025 budget on November 4th. This is a major change, as historically the federal government budget were presented in February or March, and the provincial budgets followed shortly after. So, James, what were the new measures announced in the recent federal budget for investors?
Well, François, I can say that to answer your question, not much at all. We were expecting some changes that were announced in the election for minimum RIF withdrawal rules, but they didn't happen. So most of the measures that are applicable to individuals in general were pre-announced in May when the federal government announced the middle class tax cut, which reduces the tax rate on the first bracket of income to 14.5% this year from 15%. This impacts individuals' claim for non-refundable credits. So they created in this budget a new non-refundable top-up tax credit. The budget also targeted trust planning for very wealthy people around the 21-year rule, which deems trust to dispose of property every 21 years to prevent indefinite tax deferral. Some strategies allowed property to move from one trust to another to sidestep anti-avoidance rules. So they've sort of put a monkey wrench into that. There are other minor tax rule changes, but as I said earlier, there's really not much in this budget for investors.
Well, I guess that in some ways that's good news, especially after last year's disastrous budget that proposed new capital gains tax inclusion rules that were never implemented. James, as usual, we need to remind our listeners that the insights and advice we will be sharing will be general in nature. We need a more detailed understanding of investors' tax and financial situation to give specific recommendations. Listeners should consult their tax advisors, portfolio managers, and financial planners for personal recommendations. Okay, James, so let's get into today's topics, year-end tax planning. Where do you want to start?
Well, François, first off, I'd like to remind our listeners that when we talk about tax, we adopt the optimizing mindset, which is a very different concept than let's minimize our taxes at all costs.
Yeah.
By optimize, we mean you need to think not just about the current tax year, but how your assets will evolve over the longer term and where they're located. Listeners, therefore, need to tax plan for both their current and future personal income. I have highlighted in our podcasts over the years that investors should look at their assets as three buckets. And so on the left side, you can visualize tax-deferred registered accounts like RSPs and RIFs. These withdrawals from RSPs and RIFs are fully taxed at your marginal rate.
Mm-hmm.
The second bucket is assets held in an investment holding company accounts. Not everybody has these, but let's visualize these assets in the right side bucket. These accounts most often result from entrepreneurs transferring profits from their operating companies, tax-free interco dividend to their holding company. There was withdrawal from assets built up or portfolios that are managed in these holding companies can come out in the form of either taxable dividends, tax-free dividends from their capital dividend account. The taxable dividends can be eligible or ineligible and are taxed at different rates. And then finally, you have that middle bucket, which I like to say to clients is the one you're really drawing most to pay for groceries. And that includes your tax-free savings accounts and your personal taxable accounts. Now, these accounts have the lowest tax impact when withdrawing funds.
Right. James, that's helpful. We know this works well for our clients. Now, James, what should taxpayers do to optimize their 2025 personal income taxes?
Well, François, we're going to cover a lot of ground in a short period of time. So we're really going to cover, 8 year-end tax planning areas. Capital gains and losses planning is sort of the biggest one. And what's the latest on RSP contributions, tax-free savings accounts, the new first home savings accounts, registered education savings plans, contributions and withdrawals, some stuff related to income splitting strategies, loan interest deductibility, and then finally tax installments.
Okay, gentlemen, so let's start with capital gains and losses planning. For our listeners, this is probably the biggest area of concern for optimizing their 2025 taxes.
Yeah, I agree with you, François. This is the biggest concern, particularly this year. This is, in our practice, our clients are now sitting on significant unrealized capital gains. And I remind our listeners that capital gains realized are taxed at 50% in both the personal accounts and in their holding companies. Capital gains realized in their RSPs and RIFs and RESPs are deferred until the funds are withdrawn. And of course, there's no tax on capital gains realized in tax-free savings accounts or first home savings accounts. So as the end of the year is approaching, our listeners should keep in mind, François, that if the markets maintain their current levels to year end, this will be the third consecutive year of double-digit returns. And if they've not done so already, it now really is a good time for them to review their current portfolio asset mix to really confirm if it aligns with their long-term strategic asset mix.
James, listeners are likely to find that their current portfolio's asset base is significantly overweight in stocks after the large gains generated since the lows of September 2022. Some investors may not want to pay the capital gains tax and will simply change their long-term asset mix to match their current allocation. I would, however, caution our listeners this is also changes the risk profile of their portfolios and trying to avoid these capital gains tax.
Well, every client is a unique situation, but we really have to caution our listeners about giving up on their long-term asset mix. Exactly. And so you're making a really, really important point about risk management here and discipline. So listeners should look at their asset mix in terms of what is in their safe bucket invested in bonds, and second, what is in the volatile bucket. So you think stocks, Canadian, American, international, and then REITs. Your long-term strategic asset mix should be driven largely by your tolerance to risk and your capacity for risk. Each asset class has returns that may be treated differently for tax purposes. So if you're investing outside of registered plans, you need to think about taxes. Highly taxed income is best earned in registered plans where the income is sheltered from tax annually. Again, this is what we call tax location planning.
Yeah, listeners should make sure that if they have capital loss carry forward amounts, they can use these to offset any realized capital gains if they sell. They can find this information about their capital loss carry forward amounts on their latest CRA notice of assessment or from the CRA's website.
Well, François, let's now get into the specifics of how to trade smartly to optimize your taxable capital gains or losses in your accounts. Listeners will need to know to start off how much capital gain has been realized so far in 2025, capital gains or capital losses. You start with getting the realized capital gains and losses report for year-to-date 2025 for your personal taxable accounts from your advisor or if you're a do-it-yourself from the online brokerage service. For those who have holding companies, the realized gains and losses report should be based on the company's fiscal year and which may not be the calendar year.
James, as you mentioned earlier, many of our clients are sitting on very large unrealized gains in their portfolios. For clients who have been with us for many years, they have benefited from the deferral power of passive strategies where we optimize the realization of capital gains on the equity side of the portfolio. But I remind our listener that investment decisions must take precedence over the tax consideration.
I absolutely agree, François. And this is one of those times, again, the tax bill could be quite large because of how large the gains have been. So you really need to, manage your behavior and your emotions. So really, what we're telling our listeners is they need to get back to the engineering of their portfolios. It's always important to make sure that your current allocation is in line with your long-term asset allocation. The main reason for rebalancing is really to bring your portfolio back to its long-term risk profile. In a rising stock market, if you don't realize your portfolio will always end up with a higher percentage of your portfolio in equities, therefore with a riskier, more volatile portfolio ultimately. It's therefore always better to rebalance regularly and to take profits off the table instead of waiting for a market sell-off to do it for you.
So, François, where do you start the rebalancing process?
Well, James, you should always start with your rebalancing process in the registered accounts, because selling the position that have gained will not have any tax consequences. By contrast, rebalancing in a taxable account may trigger a capital gain and taxes payable. For investors that need to make their annual RIF withdrawal before year end, that's a good opportunity to take the advantage of the rebalancing exercise to raise the cash for their withdrawal.
Well, investors also, François, need to be on the lookout for ETF and mutual fund year-end capital gains distributions. Normally, these occur in December. So these distributions are really the result of fund managers selling some of their holdings during the year. And if you hold your ETF or mutual fund in a taxable account, you will have to pay taxes on these capital gains distributions.
Yeah, and the thing is with the year-end capital gains distribution is that contrary to the monthly or quarterly distribution that are paid in cash, the capital gains distributed in December are paid as a reinvested distribution. So you're not getting any cash. There's no cash distributed to you. So for an investor who holds the position in a non-registered or taxable account, as you mentioned, taxes will need to be paid even if you haven't received any cash.
Thankfully, François, for most of the passively managed ETFs or mutual funds with dimensional that we hold for our clients, they don't really usually distribute large year-end capital gains. But it's always a good idea for our listeners who may have actively managed ETFs or others that have an underlying basket of assets that are traded, often. So again, those ETF or mutual fund providers have websites, and in November, they're generally producing estimates of what they're going to be for the annual capital gains. And so you look to their websites for where they publish that information.
Yeah, correct. And in some cases, if the fund is distributing a large capital gain, it could make sense to sell it to avoid the distribution. We've done this many times over the years. But before you go ahead and sell your position, make sure you're not triggering an even larger gain on your transaction. Also, if you're implementing a portfolio close to year end, you may want to wait the ex-dividend date before buying into the fund that will make a capital gains distribution.
Yeah, that's smart advice, François. So what else would you like to share about year-end portfolio rebalancing with our listeners?
Another key year-end tip is tax loss selling, which is the opportunity to realize capital losses that you might have in a non-registered portfolio, and then use that loss to offset any other capital gains that you have realized this year or in the prior 3 years. This strategy can offer a valuable refund if you've paid taxes on gains in the last 3 years. I would advise our listeners to consider 3 things before trading in their portfolios. Beware of superficial loss rules. Don't forget the currency impact on sale of a security held in a foreign currency, and be mindful of the last trading day for settlement in 2025, which is Tuesday, December 30th.
Now, François, I think we should share some specifics on tax loss selling for our listeners. The tax rule is any losses that are not used in the current year can be carried back 3 years or carried forward indefinitely. To be able to use a loss in the current year, the trade must settle prior to year end. So that's why your advice about trading before Tuesday, December 30th is important. Remember to avoid the loss being considered superficial. It is important that you or an affiliated individual doesn't repurchase an identical position for 30 days before or after the sale. So that's very important rule. If you want to sell something at a loss, but you really want to keep it so you buy it back, you got to wait for 30 days.
Correct.
Any other rebalancing ideas, François?
Yes, if you're an investor feels that they have already triggered a lot of gains in 2025, you can still delay triggering more gains to 2026 if you're comfortable with the current level of risk in your portfolio. We generally don't like deferring gains to another tax year because markets can turn quickly. But then again, if you're a couple of days away from year end, you can probably wait until next year. Now, James, let's look at the strategy of gifting shares. What would our listener need to know before December 31st?
Well, François, for many high-income earners, gifting publicly traded securities with large accrued capital gains in relation to the amount they invested, they can make a donation in kind of these shares or units to a registered charity or foundation. And again, this is a favorite year-end tax planning strategy. So our listeners will also need to be careful if they are planning donations that they won't run afoul of the alternative minimum tax rules.
Yeah, this year-end tax planning strategy is attractive as you get a tax receipt for the market value of the securities you're donating.
Now that's really neat. You get the full amount as a donation credit. So we do this for many clients, and taxpayers, should plan gifting in kind well before year end. This is to allow for sufficient time to execute this type of donation. And as you stated, François, if you donate publicly traded securities or mutual funds to charity, you'll receive not only a donation receipt, but for the fair market value of the gift, but any capital gain on the security will be subject to a zero inclusion rate, and eliminating the tax on the capital gain to boot. So it's a really neat strategy for people to implement for their philanthropic goals.
Yeah, it's also a good way to rebalance your portfolio because the securities you'll be gifting normally are the ones that have a lower cost base. So you've got a lot of gains there. So perhaps it's a good way to help rebalance your portfolio. James, I think it would be helpful for listeners to know about the alternative minimum tax or AMT rules and how it impacts large donations.
Well, again, that's a great point you raised, François, but we'll cover it a bit later in the podcast.
Okay, for our second tax planning topic, let's tackle RSPs.
Okay, François, the current year maximum RSP contribution is $32,490. Listeners can find their RSP room on their 2024 Federal Notice of Assessment. This number will include unused contribution room carried forward from prior years. Next year, 2026, the maximum RSP contribution will increase to $33,810 for those listeners who like to make early bird contributions like in January. So on that point, though, for business owners who they should consider declaring a T4 salary of at least $187,833 and for the calendar year ending December 31st, 2025. And this employment income will create the maximum RSP contribution that, as I said a little earlier, is going to be raised to $33,810 for 2026.
Mm-hmm. I would also add, James, that if you have turned 71 in 2025, you must convert your RSP to a RIF, and you have until December 31st to do so. But don't forget to make your final RSP contribution before you converting it. Now, I think we should look at the TFSAs, James. What do you have to say about them?
Yeah, no, that's good timing. I think tax-free savings account, they've been around since 2009, and they're starting to get very large for customers who have been investing that long with a view to the long term. So first thing, I would say to our listeners is really make sure you use your tax-free savings account properly. We see many new clients with no tax-free savings account, or they've used it as a short-term savings account, putting money in and taking it out regularly.
Right.
But you really need to think of your tax-free savings account as a long-term wealth accumulation vehicle. So let's look at the contribution rules. If you have a tax-free savings account for 2025, you can contribute $7,000. If you've never contributed to a TFSA, you may be able to contribute up to $102,000. Nothing is better than saving tax legally or not paying tax at all. And this is what the tax-free savings account offers. So, we recommend for those who haven't done it to make their contributions before year end to get your money working for you tax-free as soon as possible. There's no deadline for making a tax-free savings account contribution. Unused contribution room is carried forward. On the other hand, if you plan to make a withdrawal from your tax-free savings account, consider making the withdrawal before year end so you'll be able to recontribute those funds as early as January of 2026. If you wait until early 2026 to make the withdrawal, then you won't be able to recontribute that amount until 2027. So be careful. However, if you've already withdrawn funds from your tax-free savings account in 2025, you must wait until next year to recontribute the amount withdrawn.
Right. I would add that the CRA has announced the limit for the TFSA next year. The dollar limit will not be increased and will remain at $7,000. Best to make your contribution as early as possible in January 2026, if possible. So now let's look at First Home Savings Account. This program was launched in 2023. This is the third year for contribution for those early birds who started their plan in that year. So James, what do you have to say?
Well, again, we probably should start with explaining the rules because these plans are new and they really apply to people who are going to buy a home. So this is the children of our clients. So we've opened a fair number of these, and the earlier you start, the better. So the First Home Savings Account, or FHSA, is for individuals who are saving for a first home. So there are rules to qualify for that. You should check what they are on the CRA website. You can put in $8,000 the first year, up to a maximum of $40,000 during your lifetime. The money is generally tax deductible when you contribute. So it's like an RSP in that sense. And TFSA is not deductible. With the FHSA, the $8,000 will be deductible. The money it can be left in for up to 15 years, and it grows completely tax sheltered. And if you make a qualifying home purchase within 15 years, the money comes out tax-free. So that's the best of both worlds. You get a tax deduction and it all comes out tax-free. So, but even if you don't make a contribution right away, simply opening an FHSA before December 31st, that'll get your contribution started. And that's to your advantage because you want to be able to put the money in so that it compounds as long as possible. So for those who intend to purchase a home, therefore, we recommend starting early.
Yeah, the FHSA rules are pretty complicated. The 2025 contribution must be made before December 31st to be deductible in 2025. It's best to seek out expert advice to assess the relative advantages of contribution to an FHSA versus your TFSA or RSP. So now let's talk about the Registered Education Savings Plan, or RESP. So James, what do you have to share?
Well, again, yes, first home savings accounts are complicated, but so are RESPs. And
Indeed.
It always takes a lot of time in a client meeting to go through the rules. Clients are passionate about educating their children or their grandchildren.
Totally.
Let's start with the first side of the equation, which is RESP contribution. They are subject to a $5,000 limit, or $2,500 for the current year and $2,500 for one catch-up year. Contributions attract a federal grant of 20% and in Quebec, a provincial grant of 10%. You can contribute for a beneficiary child up until the year they turn 17 if you have less than 7 years before your beneficiary child turns 2017 and you haven't maximized RESP contributions, really consider doing it before December 31st. You're getting 30% on your contributions as free money from the government. So again, there is a limit of $7,200 in the federal government grants. And so we highly recommend people make their regular annual contributions, and if they haven't, to make the catch-up contributions. So the second part of RESP tax planning is about withdrawals. And so when it comes to saving for education, the parents get focused, they make their contributions to the RSPs for their children, but really they overlook the best way to withdraw the funds. So we help our clients by creating customized, withdrawal plan. The real issue is, as soon as the students are attending post-secondary school, you really should plan on taking money out and the years where their income is the lowest, because the part that is the gains or the grants are taxed in the hands of the children, and usually in those years they don't have a lot of income. So that's where the opportunity to optimize these withdrawals happen, and you take advantage of all the students' personal credits, including the basic amount, the tuition credit when they have school fees. Reviewing a student's expected income and credits, therefore, for 2025 really is extremely important if you're planning a withdrawal before year end.
Good. So now let's look at income splitting strategies. What would you recommend to our listeners, James?
Well, there's a lot of income splitting strategies, but I'm really going to focus on the one for investors. And the strategy we want or implemented over the years are spousal loans. And that really is to take advantage of the CRA's lower prescribed tax rates. Now, we implemented a lot of these spousal loan strategies when the prescribed rate was 1% and then up to 2%. But with inflation, that prescribed rate went way higher, and the strategy didn't make sense to implement new loans. However, the current prescribed rate is now in the fourth quarter of 2025 has dropped to 3%. So we don't believe at 3% it really is advantageous. But the idea for our listeners who don't know or not familiar with the concept is, one spouse lends to the other who has a much lower tax rate and has to pay interest at the commercial terms. So if the commercial terms is 3%, then the following year they must make a payment. So if you lend $100,000, you've got to pay $3,000 of interest. Mm-hmm. One claims an expense, the other one has interest income. But again, we feel that the strategy is still not optimal at the lower 3% rate. If it does drop further, then listeners really should pay attention to discuss with their advisors, implementing this strategy. So again, that's what I have to say for income splitting strategy for investors at year end.
What about the interest deductibility? If you've borrowed money, you need to try to make your interest cost deductible for tax purposes, right?
Absolutely. This is sort of a classic. You really want to minimize the amount of interest you're paying, and if you can, convert interest that is not deductible into interest that is tax deductible. To be tax deductible, you've got to borrow for business or investment purposes, and then you can generally deduct your interest. So if you have cash or investments in your, along with non-deductible interest costs somewhere, we consider using this cash or investments to pay down that debt, then reborrow to replace those investments. This way you'll be able to deduct the interest on your new debt. So again, one of the best strategies, guaranteed rate of return, is for investors to pay down any non-deductible debt first, because, as I said, it's a guaranteed rate of return after tax, whatever your interest rate is that you're paying.
Okay, so now let's look at the AMT rule, the alternative minimum tax rules that came into effect in the 2024 tax year. James, could you briefly summarize how AMT works?
Well, alternative minimum tax has been around for a long time, and they made some major adjustments, as you mentioned, in 2024. The alternative minimum tax, or AMT for short, this system imposes a minimum level of 20% tax on taxpayers who claim certain deductions, exemptions, or credits to reduce the tax that they owe to a very low level. So they want to make sure, people are paying, quote, their fair share of tax, unquote. So under the AMT system, there's a parallel tax calculation that allows fewer deductions, exemptions, and credits than under the regular income tax calculation. And if the amount of tax calculated under the AMT system is more than the amount of tax calculated under the regular tax system, then the difference owing is the AMT payable for the year. So think people doing tax shelters, flow-throughs, donations, huge capital gains in relation to their high taxed income. So again, AMT affects very, very few taxpayers. For 2025, AMT will apply to taxpayers who generate more than $177,882 in taxable income. So again, for investors, AMT really applies, in rare situations, but you have to be aware how and when it could impact you.
Yeah. If a taxpayer plans to make a significant charitable donation, only 50% of the donation tax credit would be allowed when calculating AMT. Secondly, if you make in-kind donation of publicly listed securities, 30% of the capital gain on those securities will be included when calculating AMT. We recommend that our listeners consult their tax advisors well before year-end to determine strategies that may help to reduce their exposure to AMT. So, James, what about tax installments for 2025? What's your advice for our listeners?
Well, again, everybody hates making them, but you have to pay quarterly installments when you have low or no tax withheld at source on your income. And so really where we're at, in November is you have to, what did you make as installments for March 15th, June 15th, and September 15th? So again, the final tax installments due December 15th. If your income's lower than expected, then you may not have to make it, but you really need to do sort of a mini tax return simulation of what income you've earned. So that's really a pretty good idea to do that simulation, because then you'll know whether you really have to make that last installment. But again, a word of caution for our listeners: if you have not made the amounts requested and you end up owing significant tax on April 30th, you may be subject to penalty interest for underpaid amounts. And so it's always safer to pay the amounts requested unless there's really major changes to your 2025 income versus the prior year 2024.
Yeah, that's very good. Do you have any other year-end suggestions for our listeners?
Yes, I have a few ideas to wrap this up quickly. You should pay your investment expenses so you can claim the deduction in the 2025 tax year. Investment expenses include the interest paid on money borrowed for investing, which we talked about a little earlier as interest deductibility. And secondly, it includes investment counseling fees incurred for managing non-registered accounts. For our retiree listeners, the dreaded old age security clawback is always a big concern. So this year, the threshold is set at $93,454, which is an increase from $90,997 last year in 2024. You need to make sure that your income does not exceed the recovery thresholds, ideally. Otherwise, taxpayers must repay their old age security at the rate of 15% of 2025 net income that exceeds that threshold of $93,454. So that, in other words, François, for every dollar above the threshold, you must repay 15 cents of your old age security. You have to give all of it up once your income reaches $151,668, but that's between the ages of 65 and 74. If you're 75 or over, the threshold is a little higher at $157,490. So this is a means test, but it also amounts to a form of double taxation. So again, when we talked about crystallizing large gains to rebalance your portfolios to stay on target, this may trigger losing your old age security for some investors.
Yeah, and this may be a reason why you would want maybe to defer gains to the next year so that you don't get clawed back on your OS. So, James, how would you like to conclude this podcast?
Well, what I'd have to say is the same thing I conclude with every year when we do this topic is that, and we've said it many times, tax planning should be done all year long. Do not wait for year end to optimize your taxes.
Indeed, and I hope our listeners do. I believe we have covered a lot of ground, James. Thank you. Hopefully our listeners will find this update very useful. I also want to remind our listeners that our comments and advice on this podcast are generic in nature, and all our listeners should consult their tax and financial advisors. So on this, thank you, James, for sharing your thought and expertise today.
My pleasure, François.
So that's it for episode number 81 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on December 24th. In the meantime, make sure to consult the Capital Topics website for our latest blog post. See you soon.